Hey everyone, happy Wednesday. Today is June 24th, 2020. The market has closed. Right now it's 8:48 p.m. Eastern Time. So let's take a look at the market. Yesterday was June 23rd. 23rd, I was talking about, the market looks like is not able to go through the 3,145, so it's probably going to come down to attract more buyers. And that's exactly what happened today. And these lines I drew yesterday, you can see the market literally follow my drawings. And the market came down. And you can see that, but something ridiculous happened today. So the market dips to this level, 3,020.50, this level. And what happened to me was that, I had my order here. And the market came down and it basically bottomed. It bounced literally 1 cent. 1 cent from my order number, from my order price. Like my order price, my limit order was 1 cent away from getting filled. And the market took off. Took away from my limit price. Right now it's back to 3,052. So I'm 1 cent away from getting my order filled today because my limit price is 1 cent too low than the actual lowest price today. So I am just kind of speechless that this thing happens. My limit order is like 1 cent away from the minimum price that happened today. So I'm just waiting for, since my order didn't get filled, I have my 20%, my position didn't get filled. Actually, more than 20%, maybe 25% of my portfolio. I want to be all in longing the market because I know the market is going to go to reach a new high. That's almost 100% chance to do. That's just judging from this market. The macroeconomics, everything is aligned for this market to make a new high. Okay, and the thing is, my order did not get filled. So if my order did not get filled today, I'm still expecting this to get filled. So I'm expecting the market, if it does come down, again make a lower dip. So usually when the market comes down, it consolidates at this level, and it usually makes a lower dip. And the reason is, it likes to do this kind of V-shaped stuff to shake people out, right? So if you look at those, they like to have these pointy V-shaped bottom. And when we consolidate at a certain level, it basically tells me that we could see another dip, which is a very high probability judging from the S&P E-mini's behavior in the past. So I basically moved my order even lower to this particular level because since it touched this level, if it does dip, it's going to dip way below that my previous limit order. So why not just take advantage of that insight so that I can get even better fill? I did not move my order too low, so I moved a little bit lower just to take advantage of that potential better price so I can fill my order. So that's exactly what I did, and so I'm just waiting on the market to open tomorrow, so maybe my order is gonna get filled, and then this probably gonna bounce from whatever level it's gonna be. I hope that does happen. Get my order filled because I want to be fully positioned for this move, for this opportunity, and I potentially this is a 10% or 12% gain if you are unleveraged, and if you are leveraged, I'm 3-time leveraged, 4-time leveraged, so I will be looking at a 30 to 40% gain in my portfolio, which is great in a matter of probably a month or two, which is very good. Like this is very good, a very low risk, a very low volatility in your portfolio, and there's no decay, there's no carrying cost for the product I bought. Very little carrying cost, that is. Of course, there's some interest expense, but that's pretty much it. Regarding carrying costs, I want to talk about carrying costs. Carrying cost means what's the cost of holding a particular financial product, right? So the cost of holding, assuming the financial product stays at the current price level. So the carrying cost of holding the S&P is actually positive because S&P has dividends, right? So assuming the S&P is going to stay at this level, if you buy the S&P, you're going to receive dividends, so the carrying cost over time is positive. The carrying cost for something like TVIX is getting delisted, right? This is a negative carrying cost product because the underlying product could stay constant, and this thing just completely just keeps decaying over time because the underlying for TVIX is actually S&P options, and options actually they do expire, so it decays over time, and as time goes on, if you hold this thing for a long term, your chance of losing money is 100%, of course, right? And in the short term, this thing has a very explosive growth. So I have been actually trading TVIX since 2016. And this product is getting delisted. It doesn't affect me because I have access to index future options. Index future options are way better tools than the TVIX. Like TVIX is, I think the decay is just too much, and the return is almost identical or sometimes superior than index option, but the decay itself really kills the product. And I'm really glad they delisted this TVIX product. The reason is, this is not a product designed for the retail investors. And the problem is, any retail investor, they open their account, they can buy this product. That's just really, really unfair to the retail investors. And this is a money burning product for almost 99% of people who ever invest in this product. And I think this product should only be available to professional traders and should never have been available to retail investor, in the very beginning. And the fact that this thing has been around for 10 years, this product launched on December 10th. 2000, which year was this? 2010, December 10th, 2010. And the very fact this product has been around for 10 years, it's just mind-boggling. It's totally corrupted, in my opinion, to even have this product to be available to retail investors. This is a highly risky product that's designed to lose money over time. And the only entity that's benefiting from this product over the long term, that's getting the positive return, is the ETF issuer, is the Credit Suisse. They issue this product, they're making that 2% management fee on the fund. And also they're making money from market making the product. They're the market makers as well. So I absolutely don't think this product should be available to the retail traders. And for the professional traders, I'm not really a professional trader because I don't work for an institution. But for anyone who has a platform able to access professional trading products like index futures, the CME, the CBOE products, this delisting has zero effect to me because I'm able to access options, I'm able to access futures, and they're the underlying product for TVIX, right? I can actually build my own TVIX product that literally behaves identically to this, and probably with even less carrying costs. Carrying costs, again, I mentioned before, the cost of holding a financial product over time, assuming the product going to stay constant. The price level underlying stays constant, and I could basically make my own TVIX if I want with my option portfolio, right? I can just hold different options that expire on different dates to have the similar performance profile as a TVIX. So it has zero effect on me having these products delisted, and I'm glad this has been delisted. It's going to be delisted, and I'm glad the regulator finally steps in on these kind of products because this is a money burning product. It's really, really bad for the retail investors, and it's totally a waste of money. This is worse than investing in this product is worse than going to the casino, right? All you're doing is just handling money to Credit Suisse, okay? All you're doing is burning your cash away to Credit Suisse. Don't think that you can catch this kind of move, okay? You're not. If you're a retail investor, you're not. You're probably going to be buying here, okay? After the move happens, it caught your attention, and a lot of people bought here, You know, by the way, I shorted this TVIX at a 1,000 level, and a day, literally within a day, it dropped to 447 because I know the reason I shorted this because the VIVIX, most people don't understand this. The VIVIX was going down before the TVIX dropped. So this is actually how you short the TVIX. You see the VIVIX going down. I saw the VIVIX going down when TVIX was actually going to 1,000. There was a divergence between the behavior of VIVIX and behavior of TVIX. I showed the TVIX right there at 1,000. A day later, 50% return, literally. Very easy. And that was it. That was it. And I did not really short it afterwards. And the reason is I was just long in the market. I didn't really think shorting the volatility is a good risk profile for me because the volatility could spike again. Back then, I don't know if the volatility is going to spike again or not. So I was just long the market, holding some S&P options and S&P futures. That was much riskless bets for me, based on my experience. And it turns out to be not really. I could have just shorted the TVIX, but it would affect my margin because TVIX requires some of the brokers really limit the amount of margin for TVIX if you invest in TVIX. So that's going to eat up my margin a lot, which is not good because TVIX requires 100% margin. And when you're doing futures, when you're doing options, your leverage could be much higher, your return could be much higher, and your carrying cost is actually much lower. That's why I'm really happy that the TVIX finally got delisted, and that's a great news for retail investors, to protect retail investors from investing in these kind of, how could I say, fraudulent products. So that's all I wanted to say, and yeah, let's take a look at the other markets. Cryptocurrency, obviously. Let's see what's going on with cryptocurrency today. Cryptocurrency today dropped, and along with the stock market. And I think that the longer we stay in this particular level, the higher chance we're going to really just go rocket up to the 20,000, probably 18,000 level. This is going to happen very likely. The longer we stay here, the higher the chance we're going to explode. And yeah, I really got nothing else to say besides that's just a matter of patience, just a matter of time before this thing happens. Really, if you're buying here, you have almost no risk of making a 2x gain. I would say 2x gain is not a lot in the cryptocurrency arena. The reason is Bitcoin. In my previous video, I talked about Bitcoin. The market capitalization for Bitcoin is too big. Right? It's too big, and it takes a lot of money to bring this to, 20,000, 40,000, 50,000. The amount of money it takes to get to these price levels exponential compared to when Bitcoin was only $10 billion market cap. Right now it's a $177 billion market cap. So that's just the case. So you're not going to get 10 times on Bitcoin in a few months. You're going to get 1 time, 2 times. So, but the good thing is the volatility for Bitcoin is much lower now because the market cap is so big, it's so liquid. And you could have used some sort of leverage products on your Bitcoin position. And you really want to be careful with your leverage though, because a sudden drop could blow your leverage to the water, right? So some of the exchanges like Binance, like OKCoin, Huobi, all that exchanges, Kraken, they offer 75 times leverage, they offer 100 times leverage, 125 times leverage. These are just horrible leverage. You don't want to take these leverage ever. That's like throw your money into the fire. That's like buying TVIX, okay? That's like buying TVIX on 10 times the leverage, on 4 times leverage. So back in the day, when I was trading TVIX, I know when the brokerages weren't limiting the leverage on TVIX, you could actually buy the TVIX with 4 times leverage, which is insane, right? The TVIX is literally 10 times or 20 times leverage on the S&P itself. And then you have four times on that, which is a 40-time leverage. No wonder your portfolio is going to go to zero when the market just moves 2% against you, or 3% against you, right? 3% times 40 times, you have 120 times kind of a risk profile, and that's just horrible. That's just horrible. So these products should be gone. Okay, do not even touch these products when you have like 100 times leverage. That's just stupid. It's just idiotic. That's just burning your money away. Please spend that money on your girlfriend, on your second wife, on your third wife, on your, on your boyfriends. On your boyfriends. Yeah, sure. If you're a girl, or on your wife's boyfriend, maybe. Yeah. That's probably even better investment by throwing money into these high leveraged products. They're not designed to making money. They're designed to make whoever issuing these products money, right? They're designed to make money for the market makers. They're designed to make money for Binance. They're designed to make money for Credit Suisse. That's how all these exchanges making billions, or these market makers exchanges, they're making billions every year. Every year, they're making billions from all these high leverage products, and people losing money from these products constantly and consistently. Okay, and that's all I want to say today, and hope you guys enjoy the rest of your night, and happy trading, and see you next time.